Understanding the advantages and disadvantages of limited liability companies is crucial when choosing the right legal structure for your business. LLCs have become increasingly popular for entrepreneurs seeking liability protection with operational flexibility, but they're not the perfect solution for every business. LLCs offer several key advantages that make them attractive to business owners. First and foremost is limited liability protection. This means the personal assets of LLC owners, called members, are protected from business debts and legal judgments. Creditors cannot seize an owner's house, car, or other personal property to pay business debts, a protection not available with partnerships or sole proprietorships. Another major advantage is taxation flexibility. The IRS doesn't consider an LLC a separate taxation entity, allowing members to choose how they want to be taxed. A single-member LLC can be taxed as a sole proprietorship, with profits reported on the owner's individual tax return. Multiple-member LLCs can opt for partnership taxation. Alternatively, any LLC can elect to be taxed as either an S corporation or C corporation, providing significant flexibility to optimize tax situations. LLCs also offer structural flexibility. Entrepreneurs can form single-member LLCs, multi-member LLCs, series LLCs in select states, or professional LLCs for licensed professionals. Members can manage the business themselves or appoint managers, providing control over day-to-day operations while maintaining liability protection. Despite these benefits, LLCs come with several significant disadvantages. Perhaps the most impactful is the self-employment tax burden. Active LLC members are considered self-employed and must pay both the employer and employee portions of Social Security and Medicare taxes. This can significantly reduce net income compared to other business structures. Administrative requirements present another challenge. While LLCs require less paperwork than corporations, they still demand more administrative attention than sole proprietorships. Members must maintain separate business accounts, keep detailed records, and file annual or biennial reports with state authorities. Failing to maintain these formalities can jeopardize liability protection. LLCs also face funding limitations. Unlike corporations, LLCs cannot issue stock, making it more difficult to attract venture capital and institutional investors. This can become a significant obstacle for businesses seeking substantial growth capital. Many venture capitalists prefer the corporate structure, with its straightforward share ownership and governance systems. The lack of uniform federal rules creates additional complexity. Each state regulates LLCs differently, which can complicate interstate operations. Businesses operating in multiple states must register as foreign LLCs in each jurisdiction, potentially facing different compliance requirements and fees across state lines. Operating agreements are essential for LLCs, but often contain critical mistakes. Common errors include failing to specify profit allocation, not defining management authority, omitting buyout provisions, or overlooking procedures for admitting new members. A well-drafted agreement minimizes confusion and protects all parties involved. Transferring LLC ownership can be complicated. Most LLCs require consent from all existing members to transfer ownership interests, unlike corporations where shares can be sold relatively easily. Without clear provisions in the operating agreement, ownership disputes can arise, especially in multi-member LLCs. Tax and compliance complexities extend beyond self-employment taxes. LLCs operating in multiple states may face filing requirements in each jurisdiction. Many states impose recurring franchise or privilege taxes, even if the LLC earns little profit. Members must often make quarterly estimated tax payments, unlike employees who have taxes withheld automatically. When comparing LLCs to other business structures, several distinctions emerge. Corporations provide easier access to investors and may offer lower overall tax rates for retained earnings, while LLCs offer flexibility and fewer formalities. Sole proprietorships are simpler and cheaper, but offer no liability protection. Partnerships allow shared management, but expose partners to personal liability. For some businesses, an LLC may not be the ideal structure. Consider an alternative if you plan to go public or raise significant capital from investors. Operate as a solo entrepreneur with minimal risk exposure, or conduct business in states where LLC fees are especially high. Understanding both the advantages and disadvantages of LLCs helps entrepreneurs make informed decisions about their business structure. While LLCs offer valuable liability protection and flexibility, the self-employment tax burden, compliance requirements, and funding limitations must be carefully weighed against your specific business goals and circumstances. Evaluating your long-term objectives and financial outlook will help determine whether an LLC provides the best balance of protection and flexibility for your business.